Okay, so let me just backtrack just a little bit. Parent subsidiary groups, when a corporation owns at least 80% or more of another corporation, Hy-Vee was a good example that we talked about there. And they can file this consolidated tax return. So they get to offset losses or offset income with losses from one of the other companies, which is a benefit. They also only have to file one tax return, and how that works is they report everything, but then they extract out the amounts that they don't own on that tax return. Let's see what else I want to say about this. So offset losses. Profits from intercompany sales are also deferred. So if one company sells items to the other company, it's not considered to be income at that point. So they get to defer it. So the election is binding on future years. So once you choose it, you've got to keep doing it. You can't change from one year to year. In addition to those sales being deferred from intercompany transfers, any losses as well from those sales also are not recognized currently. Okay. Now, brother-sister groups. This is where it's the parent subsidiary is a little bit easier to grasp than the brother-sister group. So, a brother-sister group exists if 5 or fewer persons, so it's going to be 5 or less, first off, own 2 or more corporations. The group exists if both of the following tests are met. So you have to have a total ownership test and a common ownership test. The total ownership test, shareholder, the group, owns stock representing at least 80% of the voting shares of stock, or at least 80% of the total value of all shares. Okay, so as a group, they own 80% or more. Common ownership. So the shareholder group has identical ownership or common ownership of more than 50% of the voting power, or more than 50% of the value of all shares. So, like I said, they say at first glance, the tests seem to be the same, and that it can be complicated. It is complicated. The 80% test examines ownership of an individual corporation. So the individual, so here's corporations. So you look here at these, this is all more than 80%. Each of these is more than 80%. The 50% test is based on the smallest common percentage across all of the corporations evaluated. Okay, so the total of identical ownership. So in this case, it's 60%, so it's more than 50%. So this would be a brother-sister group. So we have 4 corporations here and 3 individuals. And these are the ownership. So these 3 individuals own 100% of these companies, and Corporation D, there must be somebody else out there that owns the other 10%. But what you do is list this in a table like this. And then you pick out, for the identical ownership, you go across and you pick out the smallest number. So here, 20%. Here, 30%. Here, 10 is the lowest, 10. And add those up. Okay? Identical ownership column represents the smallest number reading across the columns I just showed. The identical ownership across all of the corporations. So we know that like 20%, all 4 of them, each of them own at least 20% of all of these, right? Some of them own more, but each of them owns at least. Same thing with the 30 and the 10. Total ownership test is met because the 3 individuals own at least 80% of the 4 corporations. So in this, they actually own all the stock, and the common ownership test is met because the common ownership is more than 50%. You add those together and it's 60%. So in this case, all 4 corporations are part of a brother-sister group. All right. So if Reed sold half of her ownership in Corporation B to an unrelated third party, would the corporations remain as a brother-sister group? So Reed, Corporation B, now there's 0. which would bring this down to 0, which would bring this to 40%, they're under 50. Now it's no longer a brother-sister group. Okay? So, and I said, you think 80% is the vertical test, the 50% is the horizontal test. But then you also have to add it up. So what does this mean? Corporations within that brother-sister group will still file individual tax returns, each of them. They don't get to consolidate. However, the IRS realizes that the common control within a brother-sister group can result in income or expense being inappropriately allocated between members of the group. It's actually, for tax purposes, maybe a bad thing to be a brother-sister group. Because what people will try to do is to make it more like a parent subsidiary. So, oh, well, let's move some of that income from Corporation B over to Corporation D because we had all these expenses in Corporation D. Let's finagle it so that we can use that income to offset Corporation D, and then we don't have as much over here. So because it's controlled by the same people, there is that risk. So what they can do, if it's a brother-sister group, is that the IRS can come in and reallocate where those income and expenses go appropriately, right? So, we don't do much on AMT. Alternative minimum tax, so everything that we've learned, there is an alternative tax universe as well. Because alternative minimum tax, because of all of the tax deductions and things, there are instances where people don't pay any tax or corporations don't pay any tax. And this alternative minimum tax takes away a lot of those deductions so that the corporation, so you figure the tax in the regular tax world, and then you go to alternate tax universe and you figure the tax, and whichever tax is larger, that's what you pay. Okay, so it's to try and prevent corporations from not paying any tax at all. Does it work? I don't know. There are a lot of corporations out there that don't actually have to pay any tax. So business interest expense limitation, this might be more applicable to corporations than it was for sole proprietorships just because of the size of the companies. So this is any interest that you pay on business assets and things like that. It cannot exceed the sum of business interest income plus 30% of adjusted taxable income, which is a separate calculation there. So that's your business expense limitation. It's disallowed in a year because of the limitation. Interest expense that is disallowed is carried forward indefinitely. So this would be another one of those book tax differences, right? Because you would take all of your interest expense as an expense on your financial statements, but on your tax return you might not be able to take all of it. This is an expense that you would cause a difference there. So here we've got Barcelona Corporation has ATI, which they already calculated for us, of 50,000, business interest expense of 10,000, and business interest income of 1,000. So the business interest expense limitation would consist of $1,000 plus 30% of the ATI, so 16,000. But the business interest expense was 10,000, so they're good. They can take all of it, right? However, here we've got Calgary Company, ATI of 20,000, business interest expense of 13,000, and business interest income of 1,000. So this would consist of $1,000, that interest income, plus 30% of the 20, which would be $6,000. So it would be limited to $7,000. They would only be able to take $7,000. The other $6,000 they would carry forward. Okay, so next year they're going to have a book tax difference there of those two. All right, parent subsidiary, brother sister.